Welcome to This Explainer. Today, we're unpacking how a major legacy fintech company is betting its absolute entire future on artificial intelligence, and they're doing it right in the middle of some incredibly harsh financial realities. We're going to be looking at Yiren Digital's Q1 2026 financial results, and specifically, their massive strategic upgrade. We'll explore this fascinating corporate pivot, crunch the raw data, look at the emerging tech, and talk about the massive stakes involved when a company decides to go all in on AI. So let's get right to the core question facing Yiren Digital today. What actually happens when a company, one that has traditionally relied on massive human workforces for loan facilitation, telesales, and customer service, decides to automate at the highest possible level? I mean, are we looking at the shining future of corporate efficiency, or is this basically a desperate Hail Mary pass in a really tough market? To really understand their strategy, we first have to understand just how far they're taking this automation. Well, to give you an idea, believe it or not, 100% of their litigation proposals are now generated entirely by AI agents. No human drafting. Zero. This isn't just some pilot program or a limited beta test they're running in the background. Every single litigation proposal they process is now handled by a machine. They've got 32 bots actively supporting their in-house legal workflows right now. It's a fundamental shift in how work actually gets done inside the enterprise, moving really high-stakes, complex, intellectual tasks away from human operators. It's honestly kind of wild to think about. They aren't just dipping their toes in the water here. This is a total, all-in AI strategic upgrade. They no longer want to be viewed merely as a fintech platform. Instead, they're actively restructuring their entire corporate DNA to be an AI-first technology company that just happens to operate in the financial sector, at least for now. But hold on a second. Before we get completely lost in all that futuristic optimism, we have to talk about the reality on the ground right now. And it's pretty harsh. We're looking at a staggering 41% drop in total net revenue for the first quarter of 2026 compared to the same period in 2025. This is the crucible that's forcing their rapid evolution. The broader macroeconomic environment, coupled with some incredibly strict new regulatory frameworks for loan facilitation in China, have just heavily impacted their traditional business operations. Let's just lay the numbers out with radical transparency. Because of those new regulatory frameworks, loan volumes absolutely plummeted. Loan facilitation volume dropped by 42%, falling from 15.2 billion RMB down to 8.9 billion. And, when your core product volume drops by nearly half, your bottom line suffers immediately. It completely erased the 247 million RMB profit they had in Q1 2025, swinging the company into a massive net loss of nearly 495 million RMB. And here is why the stakes are just incredibly high for them. A massive 87% of their total net revenue is still tied directly to that shrinking traditional credit business. They're essentially trying to rebuild the airplane while it's in mid-flight. They can't simply abandon consumer lending because, well, it's paying the bills. But they're dealing with reduced service fee rates and higher credit-related costs. So it creates this urgent, almost existential need for radical cost reduction. So let's meet the AI agents that are stepping in as the technological solution to these financial headwinds. To dig themselves out of this financial hole, they are leaning entirely on their enterprise AI architecture, specifically a multi-agent platform called MagicCube. It's fascinating to see the evolution here. They've moved from basic task assistants in version 1.0 straight to autonomous executors that can actually deliver end-to-end business outcomes in version 2.0. We're not talking about using AI to draft simple emails anymore. They've introduced Zhuangji, which is an execution layer for workflows, and Zhenao, an enterprise AI agent OS for multi-agent orchestration. The AI is centralized, governed under strict security, and basically giving the autonomy to complete massive workflows all on its own. And by handing massive workloads over to this AI execution layer, they are seeing some, frankly, insane operational efficiency gains. Just look at the cost savings. Their average outbound call cost dropped by 84% when they transitioned from human sales to AI agent sales. They're executing over 1,700 marketing outreach strategies every single day, generating that content 50% faster. Plus, as we touched on earlier, that per-case legal proposal time dropped from 20 minutes down to just 5. This is the brand new playbook for legacy companies. Offset revenue collapse by fundamentally altering your cost to serve with AI. Now, at the exact same time, they are trying to stabilize their core credit risk by playing it incredibly safe. They're prioritizing premium clients, with 78% of their Q1 loan amount coming exclusively from repeat borrowers. It's a really interesting contrast, actually. Their AI strategy is wild and aggressive,
but their lending strategy is highly conservative. In a tight regulatory environment, you don't take wild swings on unknown variables. By leaning heavily into users they already have deep, historic data on, they managed to actually bring down their 1 to 30-day delinquency rates from 3.4% at the end of 2025 down to 2.5% by March 2026.
Let's shift gears and look at a major silver lining in their report: the explosive growth in their insurance brokerage. Because while the credit side of the house is playing intense defense, their insurance brokerage business is playing spectacular offense. They experienced a staggering 413% year-over-year increase in the number of insurance clients. They jumped from just over 77,000 clients in Q1 2025 to nearly 398,000 clients in Q1 2026. That is absolute hypergrowth territory, and it proves that their wider financial ecosystem strategy actually has some serious merit. That kind of explosive growth pushed their new insurance policies to nearly 1 million in just the first quarter alone. That drove a 22% revenue increase in that specific segment, generating over 87 million RMB in revenue from insurance brokerage this quarter. It's rapidly becoming a crucial counterweight to the ongoing struggles in their legacy lending division. And a huge driver of this success is their optimized digital and internet distribution channels. It proves that their transition away from costly traditional operations is actually working in some areas. They're spending way less on traditional, physical distribution and instead using AI-assisted product matching and precision marketing to sell insurance online. It's a leaner, faster, and clearly highly scalable model for them moving forward.
But they aren't stopping at traditional finance. Let's look at the horizon of their AI-native expansion.
Yiren Digital has realized that the powerful AI architecture they built can actually be applied to entirely different verticals. So they've been making these really interesting strategic seed investments in completely adjacent industries, aiming to build entirely new pathways for long-term monetization. For example, they've invested in a Gen Z interactive storytelling studio with over 350,000 fans globally. They're also investing in generative AI adaptive learning for language skills and AI-native research platforms for academics. They're basically leveraging their underlying AI infrastructure to buy minority stakes in high-potential startups with options to acquire majority control later. They are transforming right before our eyes from a lender into an AI holding company.
So that brings us to the ultimate question I want to leave you with today. Is this radical AI takeover the brilliant evolution Yiren Digital needs to survive, or is it just introducing a brand new set of risks? Yes, they have successfully stabilized their credit risk and slashed their operational costs, but they are also navigating a massive 495 million RMB net loss and entirely rewriting their core business model on the fly. Will their bet on becoming a multi-industry AI platform pay off, or will the gravitational pull of their shrinking legacy business drag them down? It's a truly fascinating corporate case study, and for sure, one we'll be watching very closely. Thanks for joining me for this explainer, and keep questioning the data.